Hi, so today's video is for all of you who are just starting or maybe just thinking about investing in the stock market. This is exactly what I would buy today if I was starting a brand new portfolio. It is the 3 best investments that I think would be an amazing start to a portfolio. If you are new, welcome to my channel. My videos are about investments that anyone in the world can make. Now, to start a portfolio, I'm going to assume that you have income and you have a 6-month emergency fund. If you don't have reliable income or an emergency fund, well, you're just not quite ready to start an investment portfolio yet. I think the minimum you need is $1,000 to make one investment. Look, you can do less than this, but if you have less than $1,000, you have to start worrying about the fees. Now, I personally spend $7,000 at a time because that is the most efficient for fees. I also plan on making a video updating this every 3 months because prices do change. See, I'll probably have new companies that are a better opportunity because of the prices that are offered to us on the stock market. Before we get into the investments, I use Saxo Trader Go as my platform of choice. I've also in the past made a tutorial on how to use that platform, and I also have a link in the description. Yes, it is an affiliate link, but it is only because it is the platform that I personally use. Okay, if I was starting right now, based on the current prices, this is what I would buy. These 3 stocks are my favorite investments in order that can be bought right now. Okay, so you're building your portfolio. The first thing you want to buy is the S&P 500 Index Fund by BlackRock. Now, there are many reasons why this needs to be the first investment that you make. Firstly, it's really important that you'll have something that you will keep forever. See, this S&P 500 index follows exactly what the top 500 companies are doing in the stock market of America. So you actually get a small piece of Apple, Microsoft, Amazon, all of the tech companies, all of the health companies, all of the banks. You will immediately diversify yourself so you don't have to worry about trying to get the 40 or 50 companies that other people recommend to you. You're already going to own the 500 biggest companies in America, so you don't have to worry about investing in the hot stock tip that your father-in-law recommends to you at Christmas or some random investment guy on YouTube. And also by owning the 500 biggest companies, you can really focus your attention on finding the really big winners, or you can really just sit back and enjoy your life and not have to worry. Because as the economy grows and the world improves, your investment will grow with it. If you think the world is going to actually get worse over the next 20 years and maybe the robots rise up and there's a war between the humans and the robots for supremacy of the earth, well, you're probably watching the wrong video. Maybe you should go off and buy some gold and build a bunker somewhere. To invest in an index fund, you really have to believe that the long-term future of the world is going to be better than it is today. Now, the next reason you need to buy this is because it'll actually compound over time. Because what will happen over the years is, with this particular index fund based in Ireland, is that you can reinvest the dividends. Now, this is very convenient because every 3 months or so, your base amount will actually get a little bit bigger. Look at what happens to just 10 grand today. In 40 years' time, it will be nearly $1 million. That's with you doing absolutely nothing, not touching it. Just once every 3 months, ticking the box in your trading platform that asks you to reinvest your dividends. This is actually your safety net because if all your other investments fall over and things go pretty wrong in your life, well, this is your retirement fund. See, I treat it like insurance. I've paid it, it's done, and I probably won't touch it again until I'm really old. And sometimes I actually add more to it so I can have a better retirement. Actually, I won't ever sell it because when I'm older, what I'll do is instead of reinvesting the dividends, I'll start to receive the dividends as cash. By the time I'm like 65 or 70, I'll be receiving like $40,000, $50,000 a year just from the dividends from this initial 10K investment. Look, buy it at any price. It doesn't really matter because you're keeping it forever and one day you'll be living off the dividends. And I think this should be the biggest part of your portfolio at the moment. Until you get more experience, this should be the rock. Now let's quickly talk about which type of investor you actually want to be. So you could be A, a passive investor, B, a value investor, or 3, a technical investor. So you do want to invest your money, but you're not really interested in doing all the research in investigating individual companies or keeping up with what's happening on the stock market. Would you prefer to just have your money safely grow over the years, not really needing to care about it and just watching it sort of get bigger and bigger and bigger? Well, if this sounds like you, well, you're probably a passive investor. And this is great because it's super easy. So just invest 100% of your money in the index ETF that we just spoke about earlier. And all you have to do is just make sure that you elect to have your dividends reinvested every 3 months. That's it. You'll get good returns and you don't have to worry about anything. Plus, you don't even have to check on its performance or care what happens in the stock market. And honestly, this is really smart for 99% of people because the other options are really not that easy. But if you enjoy investigating companies and looking into their financials, well, you're probably a value investor like me. I like to do this and I try to get better returns than the passive investors, but it's far more work. It takes a lot more discipline and I'm always improving over the years. but I enjoy it and you should enjoy it also. The third option is being a technical investor or a day trader or a speculative investor or any other type of investment like that. Look, personally, I think this stuff is actually a bit of a joke because I think the only way to make money doing this is to teach other people how to be a technical trader. If you see an ad on Facebook or YouTube where someone is saying how much money they've made over the weekend, let me do my best impression. $5,000, $10,000, $26,000 in just 3 days. That guy is the modern day snake oil scammer. Please just run away as fast as you can. So if you want to be the passive investor, well, you don't really need to watch any more of this video. Just like it before you leave and you know exactly what you need to do. Just invest all of your money in the index fund and sit back and enjoy your life. And I think you're very smart to acknowledge that you're better off being a passive investor. And for those of you who are technical or day traders, well, you can also leave because this channel is not for you. And for my fellow value investors out there, well, let's go make some big long-term money. Okay, now a good portfolio doesn't actually have to be diversified. All a good portfolio needs to do is give us high returns and be safe, right? So we don't need companies from every different industry. That's insane. Some industries are just far superior than others anyway. And the beautiful thing with our first investment is that we're already very diversified anyway. So let's not try to diversify anymore. Let's now just go and try to find really undervalued stocks and make some money. So the second investment is Berkshire Hathaway. I've actually just done a full analysis of this company just recently, which I'll leave a link at the end screen of this video. So make sure you watch that and do your own research because at the end of the day, it's your money and you've got to make your own decisions. So here's a really quick summary. So Berkshire Hathaway historically been one of the best investments of all time. And it's run by two of the best investors of all time as well. And it has been growing at around about 20% per year since 1965. Yep, that's 55 years. Berkshire is actually just a big holding company that invests in other companies. So there's actually quite a fair bit of diversification here. But I'm not buying it for the diversification. See, it's a very stable company. It is growing really well and it is at a bargain price right now. Berkshire Hathaway's price to book normal historical average is 1.55, and right now it's actually 1.14. Just as a reference, if it was 1, it would be the company is worth the same as its assets. But for such an amazing company that has been growing historically at 20% and looks set to continue this into the future, well, it's a bargain. A return just to its normal historical book value would give it a price at around about $230 on the stock market. But because of its stability and long-term growth, I think it's worth far more than that. So it's a great opportunity to buy one of the best companies of all time and buy it under $196. The third investment I'd want to make is Bank of America. So I've recently looked into 4 banks in America and Bank of America is financially strong, but it's its current price that has made it onto the list. They are a really solid company and right now they have protected themselves nicely for the current crisis. They are far stronger than they were back in 2008 when they actually needed Berkshire Hathaway to give them some money to help them get out of some financial problems. They are far stronger than that now. And as the economy grows over the next 10 years, Bank of America and generally all banks will play a very important role. Bank of America is stable, it's boring, and at a great price. It's a wonderful investment. And if we look at their price to book value for Bank of America, it's 0.76. So if you bought all of the shares of Bank of America and then sold off all the assets, you'd actually make about 30%. And that's obviously crazy for a stable, growing company that's going to be important for the future. So the price to book ratio hasn't actually been this low since 2016, but the bank is far stronger now. There is a reason why Warren Buffett, Charlie Munger, Bill Ackman, and a long list of other legendary investors have shares in Bank of America. It's a good company at a great price. I've been buying at the current price and I'll continue to add more if the price goes lower. So anything under $29 is a good deal. Now I'm going to give you 2 bonus investments that we need to wait for, and the first one is Alphabet. Now I do think the previous 3 shares are the ones to buy right now, but Alphabet is definitely the next best. Now there are Google A-class shares and there's Google C-class shares. Now I would actually be buying the Google A-class shares. Now, for those of you who watched my analysis on Google about a month ago, I said the C-class shares were the ones to buy. But a smart subscriber pointed out to me that the A-class shares right now actually have less shares outstanding. Therefore, the A-class shares are actually fractionally better value right now. So the A-class shares are the ones to buy. Google is an amazing investment because of its incredibly stable earnings, its low debt, and it has big upside. There are so many things right with Google, but the share price has actually just crept up a little bit higher than I'd be willing to pay for it right now. Since my last video, I've actually reevaluated Alphabet, and because of some help from a very smart subscriber, I've now decided that the buy-in price would be about $1,300. And if we get this price, it's another great opportunity to buy one of the best companies in the world. Buy the first 3 companies first, but if Google falls below $1,300, I'd actually put it above Bank of America in terms of importance. Now, the last investment that I would make, but we have to kind of wait for this, is Facebook. Facebook is one of my favorite companies and it passes all of my criteria that I look for in an investment. Unfortunately, the price is just a little high. And if we get lucky and the price falls below, say, $180, well, I think that's definitely the right time to buy this company at a really good price. Look, the future looks great for Facebook and it really should be a core part of any portfolio, but it's not worth overpaying for it. So buy the first 3 stocks and then we'll keep an eye on Facebook just in case it creeps below $180. And I would rank them above Bank of America if the price was in my buy range. Now, you probably have noticed that the 3 stocks add up to 70% of the portfolio. Well, the reason is you should keep 30% in cash just in case Google or Facebook fall below my buy up to prices, or one of the other companies fall about 20% below where they currently are. Because if they fall 20% below where they currently are, it's a really good deal and you should be buying more and more. If these companies were to fall another 20%, well, they're being unfairly valued based on their financials, and I couldn't be more confident in these as an investment. Now, besides the S&P 500 index fund, which is going to be your rock, these other companies have really great upside with not a lot of downside risk. I factored in a very strong margin of safety for each of these companies, and I believe at these prices, they are very undervalued. So these are my favorite investments right now, and they're in order of what I would buy first. And currently even I'm adding to these positions at the moment, and hopefully next month I can add even more. If you want to learn how I find my buy up to prices, well, I've got a link in the description for my free calculator that you can have. It's all yours. And there's a tutorial that I made on how to use that calculator about 3 or 4 episodes back. And at the end of this video, I'll have links to the full analyses that I've done in the past, which will be here, 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 and here. I hope you enjoyed this, and I'll see you in the next video.